I think ultimately technology has to come to the rescue for fund managers to manage the complexity over a period of time. Let's say the moment it starts growing beyond 5,000 crore as an AUM for a particular PMS house, it complexity increases, and two, most PMS houses or all would start running it like a mutual fund. If the whole world knows that I'm going to buy large quantities of that stock, then naturally you will not get the right stock at your price. And price is simply saying is that it is practically not possible to double or triple your money as has been the case in the last 3 years, incrementally in the same pace as it has happened in the past. So it depends on what expectations do investors come to the table for. Well, I think opportunity is there everywhere. In every pockets, valuations are high, and in every pockets, valuations are cheap as well. So you need to do your due diligence well. I think opportunity is real. Valuations are below averages of long term, including private banks. There is enough and more opportunity for re-rating of valuation. At least we believe that way. So we are positive. And I have time and time again, every cycle I've got this message that flows is not important, fundamentals are.
Hello everyone, welcome to another exciting episode of Talks with Daulat, where we aim to deconstruct the seemingly complex world of finance and empower investors to take better and relevant investment decisions. My name is Varun and I am the founder and CEO of Daulat Wealth Management. Today we have Chandraprakash Padiyar on our show today. Chandraprakash is a senior fund manager equities at Tata Mutual Fund, having joined the mutual fund in September 2018. He currently manages 3 funds, namely the Hybrid Equity Fund, the Large and the Mid Cap Fund, and the Small Cap Fund, managing a staggering 15,000 crores. Prior to joining Tata Mutual Fund, Chandraprakash worked with Alchemy Capital Private Management Limited as a portfolio manager for their onshore long-only strategies. He has over 22 years of work experience in fund management and equity research, having started his career with UTI Mutual Fund and was a designated fund manager at that point in time. He has completed his MBA in finance from Symbiosis Institute of Business and Management and has also completed all 3 levels of the CFA. Chandraprakash, it is an absolute pleasure to have you join us today.
Hi, Varun. Thank you so much for having me. It is indeed a pleasure to have an interaction with you on markets and our friends.
So before we sort of address the elephant in the room and get started with talking about the markets, why don't we talk a bit about your journey? You started with mutual fund, spent quite some time doing that, then moved to a PMS outfit, and then again jumped back to a mutual fund 5 years ago. So just for the benefit of our audience today, Chandraprakash, if you could just tell the difference between both of those 2 investment vehicles, and why did you decide to come back and join the mutual fund industry after working with the PMS outfit?
Okay, so we're starting with an interesting questions. I would say that PMS is an interesting vehicle to manage high net worth investors' money. And personally, for me, it was the most learning experience that I could have had. So it was an enriching experience for me. For 11 and a half years, I was with the PMS. And we scaled, or we did create a lot of wealth for investors in that 11 and a half years. It's extremely positive for a fund manager as well, meaning managing money in a PMS, meaning that you get to interact with very smart entrepreneurs, industrialists, managing their own businesses. They have done very well in their own lifestyle, have created wealth for themselves, and now they were looking to give it to somebody who could maybe protect at the same time grow their wealth. So there were a lot of learning from understanding their own background and where they came from. So that was something very positive for me personally, and I learned a lot. The challenges in a PMS is about scale. As in PMS is, as we are supposed to manage it, is that different clients give you money at different point in time. And it is not one fund. It is individual client portfolio is a separate portfolio. Each client has a separate portfolio, and every client gives you money at various points in time. So the challenge comes from a management perspective. I don't think so. Unfortunately, in India, and it is improving, but I think ultimately technology has to come to the rescue for fund managers to manage the complexity over a period of time. So, for example, by the time I was from a PMS to a mutual fund structure again, I was managing something like 4,800 plus clients. When you have so many clients to manage, each of the client wanting to meet you
Correct.
regularly to understand what we are trying to do in their portfolio, their money. Uh, One, there is lack of time, and two, managing that much complexity requires, as I said, IT has to come to your rescue. It does become complex to manage from. So size is a problem in a PMS. Over a period of time, scalability becomes an issue, which is why, if you would observe, most PMS houses in the country today, apart from doing a PMS, have graduated to launch their own AIFs and have now applied to SEBI to launch their own mutual funds.
Right.
So, scale, you need to go to the mutual fund platform probably.
So while we are at it, just wanted to get your quick understanding. So in my interaction with a lot of our clients, we see that let's say somehow they feel PMS is a holy grail, right? Like let's say once they've accumulated that minimum ticket size of 50 lakh rupees, they somehow feel that they are going to get access to, a very different investment expertise, and somehow their wealth is going to get compounded at a significantly higher rate than what they would have achieved by investing in a plain vanilla mutual fund, right? So if you could throw some color, Chandraprakash, as to, how should investors think about whether mutual fund is an appropriate investment vehicle for them, or a PMS?
All vehicles are good actually. Even a PMS as a vehicle is actually a good vehicle. It's just that it is a good vehicle till a particular scale. Meaning that a fund manager and a PMS will be able to do justice to an individual client portfolio till they have limited number of clients and limited money. The moment this AUM grows, and every entrepreneur in a PMS also wants to grow, and asset management is a scale business, and up to a size in asset management in a PMS as well is suboptimal. So even a PMS house wants to grow and scale the assets over a period of time, but the structure is such that you are unable to do the same justice from a risk reward perspective for an investor when the AUM grows significantly. And you could observe, and I that's at least my observation is this, that as and when AUM for a PMS grows, let's say, and that was then, now maybe markets have grown, so maybe things would have changed. But let's say the moment it starts growing beyond 5,000 crore as an AUM for a particular PMS house, it complexity increases, and two, most PMS houses or all would start running it like a mutual fund, meaning that there is all portfolios align themselves on day one. It is a model portfolio approach. And given the size and scale, then the core strength that the PMS houses bring to the table, at least historically, meaning stock selection, bottom-up stock approach, uh, going down the curve where under-researched companies are chosen and invested for scale for the long term. Sometimes you may miss that as and when scale comes. And I think that is probably the reason why most PMS houses are launching their own AIFs and or are applying for starting their own mutual.
Okay, so before we get too technical about that, I'll stop it at the difference between mutual fund and PMS over there, and address the elephant in the room as to why we have gathered here today to talk about the markets, right? And obviously, I think I cannot have a better question than talking about the small cap fund that you run, right? I mean, this is a topic that has been going on in the markets over the last 6 months. The kind of exuberance that we have seen in the small and the mid cap space, but specifically, if we stick to the fund that you run, Chandra Prakash, right, we still see that you have over 90-95% of your holding in small cap, which is significantly higher than, let's say, your peer group, right? But at the same time, I think in the last 3 to 4 months, you have stopped accepting lump sum investments. So if you could just step back and give a sense of what are you reading in the market today? Obviously, I think there are limited opportunities from a liquidity point of view. But why do you still have conviction of being invested so much into the small cap space and not shift your holdings a bit too large?
So there are two different questions that I would want to answer in a two different manner. The first part of your question, which is uh, why do we have 95% plus in small caps, unlike our peers in the category? It's an organizational decision actually, meaning that across our funds, Tata Mutual Fund has decided that we will be true to label fund house, meaning that if we have a small cap fund, even though the features of the fund allows you to go to max up to 35% beyond small caps. So minimum 65% has to be in small caps. But internally, since day one, we have been saying that we will, across our funds, we will be true to label. For example, we have an infra fund, which will only invest in infra and related businesses and not in banking or automotive, or let's say a consumer fund. If you look at our consumer fund, you will find only consumer related businesses, not banking and auto and various other kind of businesses, which pharma, which I find in other peer comparison in the same category you will find. So as a fund house, we have chosen to be true to label. And hence you would notice that even small cap fund, for example, the question that you asked, we have always been buying only small cap. In fact, the 5% that you see today as mid cap and large cap exposure, at the time of buying, these were all companies that we bought as small caps. They over a period of time appreciated and became mid cap and large cap, which we are choosing to hold for some time. But over a period of time, we will probably book profit someday and buy another some other small caps as well. So that's the answer for your first part. Uh, the second part of the question that you asked, I will kind of break it up. And so on liquidity, market view, lump sum, stopping the lump sum flows. There, I think it's more a function of the kind of flows that we got in a very short period. So between January of this year, calendar year, and June of this calendar year, in a very short period of time, we were a beneficiary of getting large amount of positive flows. And given that we are one true to label small cap only dedicated fund, as you rightly said, small cap as a segment is relatively illiquid. Markets have been in a very good cycle of their own for small caps. So when you get a large amount of money in a short period of time, uh, and just before that, I would like to highlight that as a fund house, we are growth at reasonable price as an investment philosophy. So we follow growth at reasonable price or GARP as a model, where we would want to be bottom of stock pickers, buying businesses where we believe which are ignored, companies which are today not favorably looked at by the market early in the cycle, betting on the management teams, uh, so that if those companies can deliver very high profit growth over a period of time, then as and when they surprise the market on earning delivery over 2, 3, 4 year period, over long term, then there is a potential for re-rating in valuation because we bought it at a reasonable price. So when you get very large amount of money in a short period of time, when the whole world knows that I'm going to buy large quantities of that stock, then naturally you will not get the right stock at your price. And price is important for us. And in GAP model, the starting price, the valuations that you buy today is very important to make very fairly healthy returns over a long period of time. So it's primarily because in a very short period of time we were getting so much money, we had to do something to stop that flow. And the best alternative for us to do that was to stop lump sum flows. It was not that our view on small caps was negative. In fact, even today it is not negative. We continue to believe that opportunities, and I'm sure you will have other questions on this, but we still believe that there is opportunity in the small caps, which is why SIP continues. The only thing that we did was to control the amount of flows that we were getting. We stopped the lump sum window so that we could deploy. So, for example, in June, July, when we stopped the lump sum window, at that time, cash as a percentage of AUM had gone to as high as 16% plus. Today, we are down to back to around, or let's say at November end, we were 7%. Now we are much lower than 7%. So we have used this market opportunity to deploy capital in the market. And now I think we believe we are ready for the next 3, 4 years.
Okay. So one of the points I think that you mentioned was interesting was the huge amount of positive flows that you saw in the category, right? And obviously, so much of it has driven with the emergence of the domestic retail investor, right? Which has created some sort of a self-fulfilling prophecy where the returns have been so high that that investors continue to flock onto this fund or the category as a whole, but without keeping in mind, I would say, the risk appetite that they themselves could. Um, could adhere to in times of drawdown. So, in your view, how should investors today look at small cap from their overall asset allocation point of view? Right. Obviously, I think it's a bit of a personal question with respect to what the risk appetite is, but we see investors going full steam, so aggressive with their small cap allocation that it sometimes looks a bit lopsided.
Yeah, so maybe I'll answer in a different manner is that so I've been also traveling. I meet a lot of partners. I meet a lot of investors on a regular basis. And in recent times, I've been traveling a lot. And my observation is that since the last 3 years have been so strong for small cap investing, uh, I do observe that the return expectation for many investors continue to be or is very high, just because they have made this much of a return in the last 1 to 3 years. Uh, and what we have been doing when we are traveling and meeting partners is to bring down those expectations.
Right.
What we are basically saying is that it is practically not possible to double or triple your money, as has been the case in the last 3 years,
Yeah.
incrementally in the same pace as it had happened in the past.
Yeah.
Uh, so it, it depends on what expectations do investors come to the table for.
Yeah.
Uh, so if return expectations are reasonable, and unfortunately I can't define what reasonable means, but let's say past 10, 15 years CAGR returns would be a very good indicator to tell you what returns logically long-term investing should get, given the earning growth profile in India. So if return expectations are reasonable, I think uh, all market cap category in India, including small caps, continue to be a fairly attractive proposition for investors. But if return expectations are what what has happened in the last 3 years, then I'm afraid they'll be disappointed.
Right.
So that is what we've been telling our investors or our partners, that please come with reasonable expectations. And I think the opportunity size is good enough to deliver those expectations.
Right. I think the anchoring biases are so strong that people have been used to seeing such high returns on the portfolio that they think that this is something that is going to sustain. Right. I think that is anybody's guess what's going to happen in the future. But I think again, people are entering in the markets. So many of the first-time investors who have gotten a sense of the capital markets ever since the COVID-induced bull run in 2020. That again, people are coming in with the expectations that this is easy money. This is a place where we could, come in and make a quick buck, right? But just to stick to the point of I think valuations, I think large cap as a space, obviously, I think the general consensus is that it is a lot more attractive, right? Over the last couple of years, I think the valuations have not kept up with the earnings growth in Nifty 50, right? I think since it hit 80 peak in October 2021. Are you seeing a lot more comfort from a valuation perspective in large cap compared to, let's say, mid and small?
I think, but quickly to answer, I think yes. But there is a shade of gray there as well, in the sense that, as you all know, or as you know, every 6 months, the list of large, mid, and small gets updated. Uh, so top 100 companies is large cap, the next 150 is mid cap, and below that everything is small cap. And we are in December. So early January, we will all know what is the new list of large, mid, and small. The reason I'm trying to say this, or I want to highlight this to you today, is that there is going to be a fairly large change, a fairly decent change in what a large cap is, what kind of businesses will be classified as large cap, and mid cap and small cap everywhere. This time around, the change is going to be meaningful actually. And so as of today, the list of large caps looks quite attractive. So you are right. Last 2 years, this list of large caps have not done material numbers till now. And within this list of large cap, there is significant opportunity. Actually, we find many opportunities in our funds to buy into. For example, my larger mid cap or hybrid equity fund. We have added quite many large cap names from this list of large caps to make decent performance, or at least we expect decent performance going forward. Uh, Having said this, you should not, and this is why I'm kind of giving you a detail of this list updation, because uh, when you talk about large caps, this list, when it changes in Jan, will probably give very different results as a 100 stock category. Uh, but there will still be these stocks, some of these stocks which will still be part of the large cap universe. So you need to be very selective. All I'm trying to say is that even in large caps, one needs to be very selective. Same goes for mid cap, same goes for small cap. So if you choose your stock well, if you do your due diligence well, I think opportunity is there everywhere. In every pockets, valuations are high, and in every pockets, valuations are cheap as well. So you need to
Yeah.
do your due diligence well.
Okay, great. So that is a learning for our audience today, that there will always be opportunities that the markets will present, right? I think it is for us as investors to decipher where that opportunity actually lies. And that is obviously also where I think role of a fund manager like you comes into the picture, like to help investors who do not have the bandwidth and the resources and the knowledge to find those pockets of opportunities. Chandraprakash, just switching gears and talking specifically a bit about the sectors. Again, starting off with the PSU and the defense sector, again, something that has been investors' darling over the last year, right? I mean, we are seeing multi-year highs, but also the indices are really crossing the highs at May 2008, 2009, right? Specifically, let's say with respect to defense stocks, obviously, I think rising on the back of order books, but PSU banks again tend to be definitely in a better shape. What is your reading of the sector today? Is it really, was it long due for a catch up, or again is it just exuberance that's been playing out in this segment?
So yeah, interesting question. And I would say that maybe I want to maybe start with saying that I am one of those investors who in a large part, missed the defense rally and in some part the PSU rally as well. Uh, and there I think sometimes the more experience you have in the market tends to make you avoid some segments of the market for a longer period of time. And from experience, we know this is that PSU businesses generally tends to be more cyclical in nature. They have their good cycles, and you need to buy at the perfect time and also look to book profits at the right time. Because there are times when valuations for PSU stocks become extremely attractive, as you rightly said they were during COVID period, for example, 21, 22. Actually, they were genuinely very, very attractive. Uh, and just a small change in their fundamental earnings profile could have led to this sharp re-rating, and it actually happened. So the focus of the government of the day has been significantly towards Atmanirbhar Bharat, Make in India, and trying to promote and since when you start doing Atmanirbhar Bharat and Make in India for India, the first alternative actually comes is PSUs, and then it gradually shifts to private. As we are now seeing, for example, defense, you mentioned, uh, since earlier there were only PSU defense companies. So as and when government started giving business to domestic companies for manufacturing in India for defense, naturally everything or most of it went to defense PSUs. Incrementally, and it takes a long while. It's a 5 to 7 year gestation period for anybody new who enters in this business. Incrementally, we are now starting to see many private companies gaining some share. And these are early days. If I have to bet, I would bet that 5 years down the line, a lot of this business will move towards private because private is certainly more efficient, more productive, and is investing in the right places in R&D. So my bet would be that at some point in time, private defense companies will be larger in size and much, much more attractive for investors like us to look at. So there is a message in this for you and your investors is that uh, today most PSU companies and or the defense PSU companies are either trading at full valuations and in some cases more than full valuations. So valuations have caught up. Earning growth as of now continues to be strong. There is an opportunity. I would not reject that. In fact, I think that we believe at least Bloomberg consensus, when I see them, I do think that earning growth can be fairly healthy, double digits over the next 2, 3, 4 years, because the order books are full as of now. But keeping that earnings in mind, I think valuations are fairly valued, and hence incremental return expect. So it's again the same answer. Return expectation needs to come down.
Yeah.
These are stocks which have gone up significantly in the last 1 2 years. And if you expect similar return going forward, I think you'll be disappointed. If your expectations come down to rational levels, I think these companies maybe still have some room to play catch up going forward, but not much. And we in our portfolios we are more private oriented actually.
Okay, so the message for investors today is that there is still opportunity in the PSU and the defense stake. I think we need to just temper expectations. Obviously, I think as a sector, they are a lot more robust than what they were in the past, right? I think, what about the BFSI sector, Chandraprakash, right? Again, it is coming on the back of 4 years of underperformance compared to Nifty 50. But the Indian financial services sector, if you look at banks and BFCs from an asset quality point of view, from a profitability point of view, right? I think they are in their best shape that they have ever been. Where are you seeing opportunities in the BFSI space? Obviously, that as a category also has expanded to include capital markets players, AMCs, insurance companies, so on and so forth.
So you are very right actually, and in fact, in my whole 23 years tracking businesses and BFSI for so long, probably we are at a time where it could not have been better. Fundamentally, most banks, most financial companies are are delivering the best ever numbers. And the best part is that when we look at SMA data, which is 30-day past due, 60-day past due, uh, which gives you an indication of what incremental NPS could be for the sector, it continues to be at an all-time low, and growth is picking up. And we believe that growth will probably pick up further as and when corporate credit starts building up over a period of time. I think the opportunity is real. Valuations are below averages of long term, including private banks. There is enough and more opportunity for re-rating of valuation. At least we believe that way. So we are positive, and we think that this is one sector which has the best risk reward in the market today from our perspective. And this is a large part of large caps. In fact, in the January list, when it gets updated from the current trends, it looks like that financials will gain market share even more in that top 100 company. The only challenge is, which is what I was trying to indicate, and since you asked me, I'll try and answer this, is that there are many public sector stroke semi-government entities in the financial space where the liquidity profile or government ownership is extremely high today. In many cases, 90, in some cases, 95% of the total equity is owned by the government of India. In the public market, the free float market cap is very, very low. And because of low liquidity in this exuberant market, uh, many of these names are trading at 2 time, 3 time, 4 time price to book. Very, very unusual valuations. And I would caution you all that in case you are looking at those names, do be a bit cautious on that side. Uh, but having said this, so as I said, in pockets everywhere there are high valuations, and in pockets there are reasonable valuations to choose from. But largely speaking, financials, private banks, some public sector banks, NBFCs, I think asset management companies, there are enough and more opportunities to choose from today from a risk reward.
And finally, since we are talking about sectors, I think real estate is something that you guys have been tracking for some time right now. I think this, again, as a sector, was sort of at decadal lows a few years back, but again, on the back of reduction in leverage, housing sales being so strong, consolidation in the real estate development sector, this again sector is sort of starting to look to come of the age. What is your view on the real estate development space, whether that's resi, whether that's commercial?
So we are quite optimistic on the resi side, residential side, and the reason is pure demand supply. It's basically if you go back to data, sometime in 2018, the ready-built inventory of houses was as high as 5 years plus in India, which means that there was too much of inventory lying in the system and lesser demand. So naturally, price realization for real estate was weak. It was flat for many years, as we all know. And this is data for across the country. And this same data today is, and if you include under construction house, what I said for 2018 was all ready built inventory. There was no under construction at that time, or very little under construction. Today, even if you include under construction houses which have been launched recently, and the number of units which are available in the country is down to as low as something like 16, 17 months across the country. And there are pockets in areas in the country where ready inventory is as low as below 15 months as well, which means that builders are hand to mouth. Demand is more than supply, and which is why you notice price realization for real estate houses, residential side, have been moving higher over the last 2 years. Our perspective on this is that we believe, yes, a lot of, or when we tabulate across the country developers' plans, it does look like that builders will be in a huge launching mode. They will launch a lot of projects over the next 2 3 years. But as I said, demand continues to be built up, and inventories. Even last month, inventory went down compared to the previous month and the previous month and the previous month. So it's continuing to fall, and which means that we will probably see a good cycle for at least the next 3 to 5 years, could be longer. Which means that real estate, and by the way, in gross fixed capital formation and household balance sheets, in India, real estate contributes to almost like 40%. So when real estate does well, the whole economy does well. There is a wealth effect. There is a construction economy doing well, job creations, salaries, so everything does well. So if real estate is largest formal informal employer in the country. So everything does very well when real estate does well. And our perspective is that this will probably go on for the next 3 to 5 years, which is why in our portfolios, we've been looking at real estate favorably for some time now. And we continue to add to that exposure. Though the challenge is that in the listed space, direct developer side, there are limited opportunities to choose from.
Right.
So wherever we find opportunities, we are, from a risk reward perspective, we are adding to our exposures. The other way to do it is to buy derivatives of real estate, which
Right.
is
So building materials.
companies, home improvement companies, and plywood companies, and paint companies, and that's the way to play. And which is why we have a interesting fund that we launched 1.5 2 years back, which is the Housing Opportunities Fund. And though I don't manage this, but that's the reason why we launched that category.
Great. All right. So you've already answered that question. I wanted to sort of like, get your sense on whether we should play directly with real estate developers or their derivatives from a building material point of view, because obviously there's a lot more comfort given the history of the sector. I think before I let you go, just one final piece of question, Chandraprakash. I think this is something that I touched upon earlier, is the emergence of the domestic retail investor, right? Today, if we look at SIP numbers, it's close to about 17,000, 18,000 crores a month, right? $2 billion of domestic money is coming into the capital markets, as that's on an annualized basis, $24-25 billion, right? Whatever FIIs, FPIs have been selling over the last couple of years have been netted off by this huge amount of domestic saving that's coming into the markets. And we have been big beneficiaries of that, whether that's asset management companies or wealth managers like us. So how much typically of an importance, again, do you typically tend to look at from a flow perspective, the smart money, so to speak, right? The FII, FPI flows, or the investors, domestic investors are becoming a lot more smarter.
So, Varun, on this, I have slightly contrarian view, and I have learned the hard way actually over a period of time, is that never to focus on flows. It doesn't help. And I have time and time again, every cycle, I've got this message that flows is not important, fundamentals are. If businesses are doing well, everything will follow. If businesses suffer, then whatever money you put at it, it will fall or it will not rise. And today, the good news is that fundamentals are very strong. Economy is doing well. Every aspect, micro, macro, you look at, we stand out actually, and it looks like that we'll do well for the next 3 5 years, and hence flow is coming because everybody is positive and looking at positives. The thing that the reason why flows don't matter so much is that we all tend to look at the positive side, which is how much of money is coming. what most people tend to miss out is that when valuations start moving higher, the supply of paper starts increasing disproportionately. And we are seeing this today, though uh, IPO levels are much lower than what we saw even in 2021, for example. But secondary market sale by maybe private equity investors or promoters, entrepreneurs, or large investors, sovereign funds, it is picking up significantly almost every week, every day now. There are large deals available to buy. Some or the other seller is willing to sell large stakes in the market. So supply of paper is also increasing. So which is why I'm saying it doesn't matter. I think flows for short periods of time do matter. Like for example, Tata Small Cap Fund we talked of when in a short period of time we got so much money we had to do something about it. So we chose to lump sum for some time. But till the time fundamentals and the reason why we are bullish on small cap today as a category because fundamentally businesses are likely to do very well. Manufacturing is a space though we didn't talk about it much, but that's where there is significant opportunity that we see, and small cap is all about manufacturing, logistics, supply chain. So likewise, as I to conclude my answer, I would say that we focus more on fundamentals, and there we believe that we have fairly positive outlook for the next 3 5 years, and that's why we are optimistic.
Great. So the message for the audience today from our conversation is obviously do not read so much into what's happening on a day-to-day basis with respect to flows, right? Focus on fundamentals, focus on valuations, focus on earnings, and the rest really just take care of itself. So thank you, Chandraprakash, for doing this. This was such an insightful conversation. We touched upon a lot. We also missed on a lot of the questions that we wanted to ask you, but for the limited time that we have with you, we do appreciate you coming on our show. And for the listeners and our viewers today, if you liked this show, please feel free to give us a thumbs up and subscribe down below.
Thank you so much, Varun, for having us. It was indeed a great talk, and we look forward to doing this in future.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.